Purchasing a rental or income property can be a great way to secure your financial future and build wealth, but only if you do it properly. If you are a first-time investor thinking about purchasing in Vallejo or Fairfield or anywhere for that matter, you need to watch this video. Hey everyone, welcome back to my channel. I'm Erica Monroe. I'm a Bay Area realtor with RE/MAX Gold, and I specialize in Solano County. There are so many different approaches to investing in real estate, but today we're going to talk about the basic principles of the buy and hold approach, which means you purchase a house with the intention of renting it long-term to tenants and building appreciation and home value over time. First consideration, can you afford it? Or can you actually afford not to purchase it? Nearly everybody has debt, whether it's a current mortgage on your owner-occupied house, maybe student loans, perhaps college tuition is coming up in the near future. You need to consider your current monthly commitments or your debt and how it compares to your income. A lender can help with this as well to determine that you can afford to take on more debt, because when you purchase an income property, that's exactly what you're doing. Although your goal is of course to have the tenant's rents cover your monthly expenses, there's bound to be a period of time where you actually can't rent the home. Perhaps it's when you first purchase it and you decide to do some quick cosmetic updates. Maybe it's vacancy between tenants. Perhaps a tenant's lease ends at a time of year that's not common for renters to move in, like the holidays. So it's important to plan a little bit of a buffer to make sure that you're not adding additional financial strain to your current monthly commitments. Ideally, you have about 6 months worth of funds set aside to cover mortgage, interest, property taxes, and insurance, just in case you do have a vacancy. With the buy and hold approach, of course, the long-term growth of appreciation and home values is where you're going to grow your wealth, but we also want to cover our monthly expenses and ideally have a positive cash flow. So what does this mean? The market rent, what you should be able to command for rent in that area and for that particular house, needs to be higher than your monthly commitments. So your mortgage, insurance, property taxes, interest. You also want to create a little buffer for upkeep and maintenance, because every house is going to need that. And you may be hiring a property manager as well. You need to factor in all those expenses. That's your monthly commitment. Your monthly commitment needs to be lower than the market rent. If you are producing a profit, a couple $100 profit each month, then can you really afford not to purchase the house? You are financially better off purchasing than not purchasing the home. For the buy and hold approach, you definitely don't want to invest in a fixer or a house with a lot of deferred maintenance. You're going to be required to make these improvements over time, and you're likely going to spend 4+% yearly just to maintain the property. It's best to go with a home that's in great condition, that has good bones, perhaps not necessarily updated, but one that's not going to require thousands of dollars just to maintain or upkeep it. Consideration number 2 is location. Anytime you're dealing with real estate, it's location, location, location. Of course, you want to consider resale value, but renters are also going to look at commutable areas, access to freeways, access to amenities. They're going to look for school districts. So just as you would consider it for an owner-occupied or primary residence purchase, you want to keep that in mind for an investment property as well. However, unlike purchasing a home for yourself or your primary residence, you're likely not going to want to purchase a house in the most expensive neighborhood. You want to look for surrounding areas that still share the same access to freeways, school districts, amenities, but likely you'll be able to purchase a home at a lower price point and may even have more room for appreciation over time. Let's take a look at Solano County. Vallejo, all of Vallejo, has experienced incredible appreciation over the last year, but of course there are going to be specific neighborhoods that have skyrocketed faster. Areas like the Northgate neighborhood, Blue Rock Springs, Glen Cove. Home values have increased up to 20%. There are neighboring areas such as Granada Heights that share the same access to freeways, the same amenities, the same school districts, but allows you to purchase a house for closer to $575,000. Blue Rock Springs, Northgate, Glen Cove, home values typically begin around $750,000. So it's a big discrepancy. We're not comparing apples to apples, by the way. The homes in Granada Heights tend to be older, typically built around the 1940s or 50s, and typically feature 3 bedrooms, 1 to 2 bathrooms. The square footage of homes in Granada Heights is often smaller. The yards tend to be quite generous. I'd also encourage you to consider a home built in the 1940s or 50s. I've actually had a handful of buyers purchase in Granada Heights over the past year, and all of the houses were really well maintained. The construction quality was far superior to a lot of newer homes, so there was very little work that needed to be done. They needed some love with cosmetic fixes such as new countertops or maybe new flooring, but all relatively easy items to take on over time. Another example in Vallejo is Vala Vista versus Vallejo Heights. Vala Vista is a very desirable neighborhood. It has incredibly charming homes that were all custom built between the 1930s and 1950s. Well, Vallejo Heights is just outside of Vala Vista and also shares really charming homes, but you can typically purchase a house for significantly less around Vallejo Heights than you can in Vala Vista. Vala Vista price points tend to hover in the upper 700s to 800 plus, whereas I just had a buyer close a house in Vallejo Heights for $585,000. It was completely remodeled, incredibly charming, great location, again the same access to all amenities, freeways, school districts as Vala Vista, but significantly lower in price. Another quick example in Fairfield, new construction developments such as One Lake have been really popular because of their amenities and because they're located in what are considered strong school districts. Well, for an investor, it's probably not smart to pay the top end of value because you're not the one who's going to be enjoying all the brand new finishes. So looking just outside that area, the Goldridge neighborhood, for example, still has access to the same amenities and school districts. You're going to pay significantly less in the established Goldridge neighborhood than you would for a brand new construction house. Consideration number 3, purchasing an already tenant-occupied property. When considering a tenant-occupied property, you have to understand that the lease supersedes the sale. If a tenant has just signed a year-long lease, you cannot increase rent, you can't limit their access to the property, you can't change anything about it. Now, if the tenants are on month to month, you have a lot more flexibility. You can give them a 60-day notice that you plan to increase rent or ask them to vacate. Perhaps you're planning to do some upgrades, or you have a tenant in mind that you'd like to occupy the house. Again, for longer leases, you have to understand that you have constraints put on you that you may not otherwise if the home was vacant. Consideration number 4, down payment and interest rates. Most banks or lenders will require that you put down between 20 and 30% of the purchase price as your down payment. They want to know that there's equity in the home because investment properties are viewed as a riskier investment for the bank or lenders. Now compare that to a primary residence or an owner-occupied property. The minimum you can put down, depending on your loan type, is 3%, so it's significantly less than an investment property. Interest rates are also going to be higher with rental properties versus a primary residence. You're more likely to default on an income property over your own owner-occupied residence. It's important as an investor that you shop around for the best rate. Don't worry about your credit score getting hit. As long as those credit reports or inquiries are pulled within the same 45 days or so, it'll only show up as one hard inquiry. This is in place to allow you the opportunity to shop rates because not all banks are created equally and not all loan types are created equally. We want to minimize the amount of money going out the door, so make sure you do your due diligence, get additional quotes, and find the loan and lender that's going to keep your monthly payment as low as possible. If you're excited about purchasing an income property, check out my video on housing market projections for 2022, and also make sure you understand our county loan limits. check out 2022 conforming loan limits in Solano County. Thanks so much for watching. Please like, comment, subscribe. Reach out to me if you have any questions, comments, or would like to work together.